Team Synergy presents JCP, a corporate turnaround story. Team members and responsibilities. Jarrett Leong, team leader, minutes keeper, and calendar. Brandon Wong, Google Apps owner and content management. Sean Shimizu, quality control and researcher. And Jaylin Kashiwabara, researcher. The company we are doing our financial analysis on is JCP. They are a mid-range department store selling apparel, housewares, and bedding. Their stock symbol is JCP and are traded in the New York Stock Exchange. Their SIC code is 5311. They currently have 1,107 locations in 49 states and are based in Plano, Texas. The company was founded in 1902 by James Cash Penny in Kemmerer, Wyoming.
JCP was once an industry leader. Now it's on the brink of irrelevance. Can a turnaround bring it back to prominence, or is it already too late for a comeback? Our thesis is JCP has the resources to survive the short-term rigors of a turnaround while displaying the potential to be a successful long-term investment. Based on our extensive research regarding corporate turnarounds, we came up with a few general givens. We also came up with assumptions regarding our industry based on extensive research of competitors and current state of industries itself. Here are givens and assumptions. JCP is on a decline, is attempting to execute a corporate turnaround. Turnarounds in general take time and money. There are short-term losses in order to realize long-term gains and the overall sustainability of the company. This leads us to the assumption that turnarounds are for long-term investors, not short-term investors. This is why we will focus on recommendations for the long-term investor. And then lastly, Macy's is currently the industry leader. This leads us to analyze and compare the two companies in order to better understand the current state of JCP.
Here we can see a basic comparison of various ratios between the two companies of JCP and Macy's. A quick glance at the chart shows that Macy's has higher revenue, net income, and total assets, while JCP retains higher liabilities. Based on this, we can see that Macy's is the dominant leader in the industry. Because of this, we explored and sought a more in-depth analysis using the unique industry-specific ratios of sales per square foot, same-store sales percentage, and gross margin of percentage of sales. The ratio of sales per square foot is a popular sales metric used in the retailing industry. This ratio measures the efficiency of a store's management in creating revenues with the amount of sales space available to them. With this ratio, we see that the higher the sales per square foot, the better the job management is in doing of marketing and displaying the store's products. The 2011 sales per square foot ratio of Macy's is $162.15, as opposed to a lower ratio provided by JCP's of $159.13. Because of the higher ratio provided by Macy's, we see that Macy's does a better job in creating revenue based on the amount of sale available to them. This may be due to the fact that the management has certain successful methods of maximizing their profits within their limits of space. The assumptions that we can make from the comparison of these two numbers are that JCP's management is weaker than that of Macy's because of lower sales per square foot number. We can also see that JCP has more stores than Macy's, thus having more square feet. The fact that Macy's number is higher is based strictly on the amount of revenue that Macy's has that creates a greater revenue of JCP. Okay. The ratio of same-store sales compares sales of stores that have been open for a year or more. This ratio is presented in a percentage form, indicating investors to determine what portion of new sales has come from sales growth and what portion has come from the opening of new stores. This analysis is important because although new stores are good, there is a saturation point in which future sales growth is determined by the same store sales growth. Macy's 2011 has a same store sales percentage of 2.6%, while JCP's percentage of 2011 equals 2.5%, which is a difference of only 0.1%. Because of these ratios, both have the position to be comfortable to open more stores in the future. Due to the fact that JCP closed a lot of stores within this year span, while Macy's opened many, we can safely say that their ratios are about the same because of that. Since Macy's is our rising industry leader, more stores have opened within this year span, and when backed by this percentage, allows more stores to be opened because they are doing well. JCP has closed stores, lowering their same store sales percentage, but by doing this made more money in order to open more stores. The ratio of gross margin as percentage of sales is basically the revenue minus the cost of goods divided by the revenue. The higher the percentage, the more the company retains on each dollar of sales to service its other costs and obligations. Since Macy's and JCP are both mid-range retail stores, their levels of gross margin should be the same because of similar products sold. Macy's 2011 ratio is 40.71%, which exceeds the 2011 ratios of JCP's of 39.19%. The numbers might not be that much, but still is enough to show that Macy's would be considered the dominant industry leader. Since Macy's has a higher percentage, they have more money to spend on other obligations, while JCP has less. Macy's could use more money that they profit to open more stores, claiming its control as the industry leader.
We will analyze the following questions. Can they survive the short-term setbacks associated with a turnaround? What's going for them? What's going against them? What key areas are questionable? What are the major things they plan on doing? And lastly, what should they do?
Can they survive the short-term setbacks? The setbacks are, a lot of money needs to be invested in rebranding, marketing, and infrastructure. In a typical turnaround, there is major downsizing, and in the short term, revenue will decrease. We felt that these were the important ratios that correlate to a company's short-term survival. Debt to equity, current ratio, inventory turnover, and acid test ratio. Debt to equity ratio is a measure of a company's financial leverage calculated by dividing its total liabilities by stockholders' equity. It indicates what proportion of equity and debt the company is using to finance its assets. A high or low ratio is open to interpretation. With Macy's high debt to equity ratio, it means that it is currently aggressively financing its own growth with debt. Macy's is confidently acquiring debt, expecting a lot of earnings from its investments. JCPenney has a low debt to equity ratio, which means that although it doesn't seem to be investing a lot of money in itself, it has the financial ability to do so. Current ratio is mainly used to give an idea of the company's ability to pay back its short-term liabilities, like debt and payables, and pay it back with its short-term assets like cash, inventory, and receivables. The higher the current ratio, the more capable the company is of paying its obligations. A ratio under 1 suggests that the company would be unable to pay off its obligations if they came due at that point. While this shows the company is not in good financial health, it does not necessarily mean that it will go bankrupt, as there are many ways to access financing, but it is definitely not a good sign. Both companies seem to be in very good standing and have the assets to pay any short-term liabilities when needed. For JCPenney, this means that it is currently able to pay off any short-term liabilities and is in no way in high risk of going into bankruptcy. Inventory turnover is a ratio showing how many times a company's inventory is sold and replaced over a period and is calculated by dividing its sales by the amount of inventory. This ratio should be compared against industry averages. A low turnover implies poor sales and therefore excess inventory. A high ratio implies either strong sales or ineffective buying. High inventory levels are unhealthy because they represent an investment with a rate of return of 0. It also opens the company up to trouble should prices begin to fall. Because we know JCPenney's sales haven't been the strongest, their high inventory ratios must have came from another problem. JCPenney had a manufacturing and shipping problem with merchandise coming from China. Miscommunication and delayed cargo ships caused JCPenney to not receive their full inventory for the year. In our team opinion, caused the ratio to be a little higher. Acid test is a stringent indicator that determines whether a firm has enough short-term assets to cover its immediate liabilities without selling inventory. The acid test ratio is far more strenuous than the current ratio, primarily because the ratio allows for inclusion of inventory assets. Furthermore, if the acid test ratio is much lower than the current ratio, it means current assets are highly dependent on inventory. Retail stores like Macy's and JCPenney are examples of this type of business. By looking at the numbers, it doesn't really tell the entire story. Macy's inventory is worth over $5 billion, while JCPenney, on the other hand, only carries a little over $3 million in inventory. With Macy's ratio way below 1 at 0.38, it is really depending on its merchandise to pay off its debts. Our team concluded that Macy's is right in having the confidence to do this because of its strong sales and turnover. JCPenney's is just under 1, showing that it has the assets to cover immediate liabilities and does not entirely depend on its inventory.
So what's going for them? First, longevity. JCP has been around for 108 years. They have a very familiar name in the retail industry, and they have established long-term relationships with key manufacturers. Second, while most of the companies that require a turnaround do not have the luxury of making one major mistake, JCP is financially stable to attempt a turnaround without much worry of bankruptcy. So what's going against them? First, JCP has not clearly articulated a clear reason to shop at their store. Second, JCP doesn't have a proprietary product. Plus, all good strategies they create can easily be emulated by their competitors. But most importantly, history. According to historical analysis, corporate turnarounds are not successful and lead to company irrelevance or bankruptcy. What key areas are questionable? We're going to examine leadership and department store models. Let's first examine leadership. Company turnarounds are a direct result of team leadership's vision and execution. The problem with JCP is that the CEO and chairman of the board, Myron Ullman, has been held the position since 2004. It is suggested that people who create the problems in the first place will not know how to fix them. This is primarily why turnarounds need new leadership with new vision. Having the same leader with a new vision could work. However, it could mean the same company with the same ideas but just packaged differently. Sometimes you can't teach an old dog new tricks. In Ullman's defense, he did address the stockholders that the theme of the year was transformation. He constantly used the word evolution. Also, under his leadership, he was credited for surviving the most recent economic recession. He is also credited for enhancing the company's reputation for style, customer service, innovation in the digital sphere, and improving operational efficiencies. This is important since it shows he has a track record of success and, more importantly, credibility with the employees. We feel that the biggest role of the CEO during a turnaround is not just the vision itself. It is the ability of the CEO to get the employees to buy into a new vision and direction. It makes no sense whatsoever if a person executing the vision isn't fully committed. This is why Myron's might have an advantage since he's already demonstrated loyalty of the employees, whereas a new CEO would have to build his credibility, being the new guy with the company. Additionally, since Myron is the CEO and chairman of the board, he also has more control over the company. This is particularly important during a turnaround since bold and radical decisions are constantly made and may not be the popular decision. The second questionable area is the department store model itself. The argument is that the traditional department store model doesn't work anymore. Why? Department stores have to deal with two major competitors: deep discounters such as Walmart and Target, and high-end specialty stores such as Prada, Louis Vuitton, IKEA, Best Buy, and Williams-Sonoma. The deep discounters challenge them on price, convenience, and selection. Basically, you get more value for less money and time, especially in this value-conscious economic times. The high-end specialty stores offer well-defined and defendable niches. They are able to turn products more quickly and react faster to the latest trends. Bottom line, department stores are product emporiums filled with too much merchandise. Consumers often see them as being very less innovative while offering mediocre service and product knowledge. As we know, the only constant in retail is innovation. Most department stores simply stop innovating. So what are the major things they're doing? We examined 4 major areas: rebranding, downsizing, new targets, new programs, initiatives, and partnerships. What are the major things they're planning on doing? We examined 4 major areas: rebranding, downsizing, new targets, and new programs, initiatives, and partnerships. They have a new vision and starts with rebranding. Their new logo is "New Look, New Day, Who Knew?" JCP has initiated a new marketing campaign for their brand. They have introduced a new company slogan, reinvented their logo, and changed from JC Penney's to just JCP. Another company did something similar with highly effective results. KFC used to be known as Kentucky Fried Chicken. They changed it to KFC primarily because of the negativity surrounding the word fried. This minor change drastically boosted sales, especially in the new trend of eating healthy. Additionally, changing from JC Penney to JCP could help them get rid of some of the negative stigma surrounding the name. Amway is a perfect example of a company in which its very name was associated with negative attitudes, which were mainly embedded in the subconsciousness. Next, they have downsized and become a leaner company. 2011 will be the year of efficiency for JCP. The CEO has already made it clear that all programs, personnel, and departments will be evaluated, and some will either be eliminated or consolidated. In general, JCP will slash its capital expenditures, reducing investments in areas of business that no longer contribute meaningfully to its financial performance. JCP has decided to stop printing their catalog, close all 19 of its catalog outlet stores, and 2 call center facilities. This is an attempt to save money and focus those savings in a stronger web presence. In downsizing and closing stores, the company gained tremendous returns on their real estate investments. Many old realtors are actually big real estate owners. JCP's property is worth about 63% of the company's market capitalization. This also explains why this is a much better liquidity ratio than Macy's and can be a safer investment if you're thinking in terms of asset protection during a possible bankruptcy. JCP has also redefined their targets. They are now targeting younger customers since they recognize the power of brand loyalty from a younger age, and they also decided to enter the bridal industry. This is a market they can be very niched in. New programs. JCP has a JCP Rewards program, something similar to Macy's, which recognizes the importance of data collection and, more importantly, analyzing the data to create better marketing and sales strategies. Customer First program, JCP Insiders, which draws 5,000 trusted advisors of sorted backgrounds, and JCP Cares, which is a community-based program. The new initiatives is social media integration, primarily through Facebook and Twitter, mobile shopping, and door to floor, which enables store managers to know what's being delivered in trucks 24 hours in advance, which speeds up turnaround times. JCP has also made and formed some exclusive partnerships with Liz Claiborne, Sephora, Call It Spring, and MNG by Manango. So Team Synergy recommends that JCP makes 3 major changes. Bring in new leadership, especially someone with a track record of corporate turnaround success and possibly a background involving technology. 2, focus on transforming the shopping experience. JCP should shift away from simply selling merchandise on racks to selling experiences and lifestyles that connect to targeted shopping segments at an emotional level. This will help increase the frequency of customer visits and the size of the average purchase, and tailor offerings to target segments. In general, this means offering fewer categories but deeper assortments. So our call to action. We encourage you to track the following ratios. These ratios have proven to be particularly well suited for use in telling the story of a turnaround situation. Price-earnings ratio, especially during the redirection phase. Return on sales, especially year to year and in comparison to other retail companies. Debt coverage ratio, after the final phases of turnaround, this ratio is more of an evaluation of the turnaround. And gross profit margin. In conclusion, we believe the company will live and die by its leadership. We think they have a solid vision. Now the question is if they can execute it. We feel that JCP has the financial stability to withstand the expected short-term losses. We believe JCP should be categorized in the high-risk, high-reward area. Basically, we see it as an investment with a significant upside. We suggest all serious investors to be patient as JCP goes through the turnaround. The transformation of company will take several quarters to even begin to show financial results. Ultimately, we see JCP eventually making a comeback as a dominant retailer in the industry, leading to much financial gains for their stockholders. In general, JCP is a solid buy.